Over the last couple of weeks, a lot of Chinese companies listed in the US have released their latest earnings. In this video, we will take a look at 5 of them: HUYA, DOYU, Baidu, Alibaba, and Tencent. We will first look at earnings before checking the latest news and reviewing the price movements. If you want to find out more, stick around and please leave a like to help the channel. Let's start with Baidu. For the 10th consecutive quarter, Baidu beat analyst earnings expectations with an EPS of $2.3, which was $0.29 or 14.4% above expectations. However, Baidu's earnings were lower than last quarter and 25.5% lower compared to the same period last year. Plus, the GAAP EPS was minus 7.48, which is a big loss. That's not great for the share price because price follows earnings, as Peter Lynch likes to say. Even though Baidu's revenue was in line with expectations at exactly $5 billion, this is their highest quarterly revenue ever, with a 4% increase compared to last quarter and 16.7% increase compared to last year. That was driven by Baidu's AI cloud, which grew by 73% compared to last year. Cloud is massively growing in China, with Baidu and Alibaba being two of the main players in the country. So let's take a look at Alibaba. Alibaba posted one of its worst earnings releases ever. Alibaba failed to meet earnings expectations with an EPS of only 1.75, missing analyst expectations by $0.19 or 9.7%. This is a 31.9% drop from last quarter and 35.6% drop from last year, which is really concerning. On top of it all, Alibaba missed revenue expectations with only $31.4 billion. It is still 33.8% higher than the same period last year, but the revenue came 2% under analyst expectations. Out of the last 3 earnings reports, Alibaba has failed to meet earnings and revenue expectations twice, which is very concerning for a growing company. Even worse, Alibaba reduced their revenue guidance for the current fiscal year, which is typically not a good look, and it's even worse when combined with both an earnings and revenue miss. Then we've got Tencent. Unfortunately, Tencent missed both earnings and revenue analyst expectations for the latest quarter, just like Alibaba. Tencent reported an EPS of $0.51, which is what they also reported last year. In terms of revenue, Tencent reported $22.28 billion, which is 2% under expectations, although it still shows a 17.5% increase as compared to last year. Tencent's biggest segment, gaming, is doing well, increasing by 28% as compared to last year if we take out changes in currency. Tencent's second biggest segment, fintech and business services, also grew by 30%, which was good to see. Overall, Tencent is posting a decent revenue growth, but its profits are lagging behind. The next company is HUYA, who released their earnings on the 9th of November. HUYA reported an EPS of $0.12, which was $0.06 above analyst expectations, basically double of what they expected. That looks good, but we need to remember that analysts massively reduced expectations in the month leading up to the earnings release. Plus, HUYA had an EPS of $0.23 for the same quarter last year, and an EPS of $0.16 for last quarter, so we can see that HUYA's earnings are trending down. On the upside, HUYA reported a revenue of $465.5 million, which was 2% under analyst expectations, but it was still 10% higher than last year and 2% higher than last quarters, so there's a steady improvement there. Their paying users for HUYA Live remained the same number as last year, so no changes there, even though their total mobile users went up by 15%. Now, let's take a look at DOYU, which are essentially HUYA's main competitor, even though both companies have Tencent as their majority owner. Just like HUYA, DOYU beat the analyst earnings expectations by $0.01 with an EPS of minus $0.03. But again, the expectations were lowered going up to the earnings, so an earnings beat does not mean much. Their EPS for the same period last year was $0.06, so there is a big drop there, although the current EPS is slightly better than the previous quarter. In terms of revenue, DOYU missed expectations like HUYA by just under 1%, which is pretty much in line really. However, DOYU's revenue has dropped over 5% from the same period last year, which is not good. Also, their paying users have dropped by 10% year on year to just 7.2 million in the latest quarter. So, The overall trend here is a slowing revenue growth and slowing earnings. We can see that in the results and we can see it in the guidance. So, why is this happening? There are several reasons behind this. First of all, the Chinese economy has been slowing over the last quarter, which has concerned a lot of investors. Inflation is also going up worldwide, along with shipping costs. Then, we have still not seen the fallout from Evergrande's collapse in China, and that is worrying. Evergrande has the potential to inflict a massive hit to the global stock market. We also have the new regulations around data security, data privacy, gaming, tech companies overall. We've seen Alibaba and Baidu taking a revenue and earnings hit. We have seen Alibaba getting the massive fine. In addition to all that, DOYU's CEO has also just reported that Chinese regulators have suspended the approval of new games in China to tackle the perceived video game addiction by Chinese youth. This will cut into the earnings of the gaming industry, in which DOYU, HUYA and Tencent are involved. Basically, the next 3 to 6 months look a bit bleak right now, although some analysts argue that this is setting up China for steady growth after an initial slowdown. Personally, I'm currently bearish on China. We've seen the latest price action for HUYA, DOYU, Baidu, Alibaba, Tencent. We had a few false breakouts, but in the end the prices dropped again. All 5 companies currently trade at a massive discount. HUYA and DOYU are trading at their all-time lows. Alibaba is trading at a PE of 17.5 compared to its historical average of 27 to 30. When's the last time that Tencent has traded at a PE of 21? Over 5 years ago, maybe more. All of these look like amazing bargains right now, but are they? I read a detailed interview with Stanley Druckenmiller years ago, and he said something along the lines: don't look at the fundamentals, look at what's moving the price. With DOYU, HUYA, Alibaba, Baidu and Tencent, there's been 2 main things moving the price. Regulation is the big one, but there's also the slowdown in revenue and earnings. This tells me 2 things. First of all, investors want to see reassurance that China will not destroy its tech companies. There is a decent chance that China will want to exercise more control over its tech companies, maybe even place members of the CCP on the board like it did with ByteDance, the company behind TikTok. Do you know what would happen if they do that? These companies will be delisted from US stock exchanges. Just think of all the institutions and hedge funds that would have to exit. Share prices will plummet. I'm not saying that it will happen, but there is a small chance. Plus, the Chinese government has outlined a 10-year plan that includes strict regulation of big tech companies. A 10-year plan. I wouldn't hold my breath for any good news in terms of regulation there over the next year. Second of all, investors want to see better earnings. However, again, we need to see signs that earnings will be improving, and this will not happen for at least 3 months ahead. Most likely for longer if the slowdown in Chinese economy continues. The way I see it, buying these companies is a bet on the actions of the Chinese government. Personally, I think this is extremely risky. I have less than 2% of my total portfolio in these companies, and my plan is to continue adding a bit every month in case I turn out to be wrong, but keeping my overall exposure to about 2.5%. However, I know that a lot of retail investors are bullish on these companies. There are good reasons behind it, but I think it's extremely important to consider the risk here and manage the exposure. As Peter Lynch likes to say, be careful when thinking that a company cannot go lower, because it can, and often it will. DOYU, HUYA, Alibaba, Baidu and Tencent can very well turn out to be value traps for the next year. We still haven't seen any signs that the bearish trend in their prices has been reverted. If you want to buy the dip, that's fine, but just be careful and manage your exposure. I'm not a financial advisor and you can make up your own mind, but just do your research and think about the risk. I don't think we will see a big rise in price until we see a catalyst, and I think there are stocks, even indexes, that can offer better returns over the next 12 months. But that's just what I think. What do you think? Are HUYA, DOYU, Alibaba, Baidu and Tencent good picks right now? Or are they value traps? Let me know in the comments below. If this is your first time here, please like, share and subscribe. Thanks for watching and see you again in the next video.